Hi, I'm Justin Kelly with CPF Mortgage. Today I wanted to talk to you about adjustable rate mortgages versus fixed rate mortgages. Let's start out with fixed rate mortgages. Very, very simple, right? You're choosing a product, you're getting a loan, and you're getting an interest rate on that loan. With a fixed rate, that means if you get a 30-year term, your rate is going to be fixed for the entire 30 years. So your monthly principal and interest payment will never change. Now, flip to an adjustable rate mortgages. These are becoming more popular as rates increase. You can get a lower introductory rate, right? Or a lower fixed period, if you will. Okay, so let's talk about maybe a 3, 5, 7, or 10-year fixed mortgage. These mortgages are still amortized over 30 years, which means the payment is based off of a 30-year term. However, the interest rate may only be fixed for a specified period of time, be it 3 years, 5 years, 7 years, or 10 years. Once you go through your fixed rate period, it then becomes an adjustable rate. And at that time, depending on the type of adjustable rate mortgage you have, you may see some increases and or potential decreases depending on exactly the terms of your adjustable rate mortgage and how everything was set up for you. Some of the things you'll want to look out for or pay attention to when you're getting an adjustable rate mortgage is how long is the rate fixed for? Is it fixed for 3 years, 5 years, 7 years, 10 years? What is the interest rate and or the adjustable rate based off of? Meaning what index is it based off of? Because that's what will determine how high or how low your mortgage rate can go once you've gone through the fixed term. So historically, and we're speaking in the 2008 period, there was a lot of different types of adjustable rate mortgages out there. Some of them, were dangerous for borrowers, and we'll talk about one in particular, which was a negatively amortizing loan. Those loans were almost worked like a credit card, where you were making a minimum payment. You weren't even making the minimum interest payment on those loans. You were just making a minimum payment, and then any interest that you weren't paying was getting tacked on to the end of the loan. Well, that was a problem as the balance continued to increase. What you owe continued to increase at that point in time. Since then, we've had a lot of regulatory bodies come down. The government has kind of put some controls in place to make it safer and better for homeowners out there. So the adjustable rate mortgages of 2008 are not what they are here, in present day. It may be for qualification purposes. You need a lower interest rate in order to qualify up front. It may be because you don't plan on being in the home for more than 5 years, 7 years, 10 years. You may have a plan where you're retiring in a short period of time, in 3, 7, or 10 years, and you'll have a lump sum of money at that point in time where you can pay the mortgage off. You also may have plans to refinance the mortgage out of an adjustable rate and into a fixed rate if rates come down. So there's several reasons why somebody would want to take a look at an adjustable rate mortgage and potentially go down that road. You can always refinance out of an adjustable rate mortgage later on once you reach your adjustable period. If you want to look at it then, and maybe you're coming into a lump sum of money, you want to pay it off. Maybe you want to refinance. Either way, you can always pay off the adjustable rate mortgage and or refinance into another mortgage. So I hope you have a clear understanding of the difference between a fixed rate and an adjustable mortgage.